Silver's sitting at a critical inflection point, and honestly, I wasn't planning to record this today. My plan was to wait for the data, let everything settle, and then deliver a clean analysis. But I keep seeing the same tired narratives flooding my feed. On one side, you've got the extreme bulls screaming that silver's about to explode, and you need to load up immediately. On the other, the doomsayers are convinced everything's collapsing and silver will get demolished. Here's the truth. Both camps are missing the complete picture. So here I am, diving in before the storm hits, because what happens this week will genuinely matter for anyone holding or considering a position in silver.
Before we go deeper, I need you to do something. Drop a comment right now telling me what date you're watching this and where you're tuning in from. Your city, country, whatever you're comfortable sharing. I actually read every single comment. It helps me understand this community and what resonates with you. And if you're getting real value here, smash that subscribe button and hit notifications. It's completely free, takes literally 2 seconds, and it ensures you don't miss critical updates when markets are moving fast. Now let's get into what's really happening.
Silver has been stuck in an absolutely maddening consolidation pattern. If you've watched the charts lately, you know the feeling. Price climbs, gets rejected. Drops, finds support. Chops sideways in a range that seems specifically engineered to frustrate everyone with skin in the game. This isn't random noise. This is what markets do when they're coiling up, waiting for a catalyst to unleash the next major move. Think of it like compressing a spring. Pressure builds, energy accumulates, but nothing releases until something triggers it. Traders keep hesitating at key levels because nobody's certain which direction wins. That uncertainty creates this choppy mess where both bulls and bears are getting beaten up while the market decides its next direction. This week might finally give us that answer. We're getting U.S. non-farm payrolls and consumer price index data, and if you don't grasp why these reports are absolutely crucial for silver, let me spell it out plainly. The Federal Reserve controls interest rates, and those rates impact everything in financial markets, especially precious metals. When rates are elevated or expected to stay high, silver struggles because it doesn't generate yield. It just sits there. When you can earn 4 or 5% in treasuries or money market funds, the opportunity cost of holding silver becomes significant. People naturally ask why they should park capital in an asset that pays nothing. That's been silver's major headwind. The Fed raised rates aggressively, real yields stayed elevated, the dollar remained strong, and precious metals felt the pressure. Gold held up better because of its pure monetary role in central bank demand, but silver, being smaller, more volatile, and more industrial, took harder hits. Here's where it gets fascinating. Markets are currently pricing in some Fed rate cuts. Not dramatic cuts, but enough to provide silver with support even amid this choppy action. The problem? That expectation is fragile, built on assumptions about cooling inflation and a softening labor market. If this week's data challenges those assumptions, the market repricing could be brutal. When NFP drops, what's everyone really watching? Whether the labor market remains hot or shows cracks. Strong employment numbers, robust payroll gains, low unemployment, rising wages, that's hawkish for the Fed. It signals the economy's still running too hot for rate cuts. If markets are pricing in cuts and the data says otherwise, you get a hawkish repricing. Yields spike, the dollar strengthens, and silver sells off hard. Conversely, weak jobs data, disappointing payrolls, rising unemployment, slowing wage growth, that's dovish. It suggests the Fed might need to cut rates sooner or more aggressively than anticipated. That's when traders flood back into silver because the headwind transforms into a tailwind. The same logic applies to inflation data. CPI matters because it's the other critical input for Fed decisions. Sticky inflation means the Fed stays cautious on cuts, even if employment softens. But continued cooling in inflation gives them room to pivot, and even the expectation of a pivot completely changes the game for assets like silver. When I say this week matters, that's exactly what I mean. We're not just watching numbers, we're watching the inputs that determine whether silver's headwinds persist or start shifting. And silver, volatile as it is, will react violently either way. Let me address something that genuinely frustrates me about most precious metals coverage. People treat silver like it's just gold's shinier, more volatile cousin, moving for identical reasons with bigger swings. That's a lazy analysis that will cost you money. Silver is fundamentally dual-natured. Yes, it's a monetary metal with thousands of years of monetary history, embodying the same store of value narrative as gold, a hedge against currency debasement and a hard asset when paper promises fail. That's legitimate. But silver's also intensely industrial, and that industrial demand isn't some footnote, it's massive. Consider the applications. Silver's the best electrical conductor of all elements, making it essential in electronics. It's critical in solar panels. Every photovoltaic cell requires silver for connections. Scale that across global solar build-out, and you're talking serious tonnage. Electric vehicles, 5G infrastructure, medical applications, water purification, the list extends far. What matters for price is that industrial demand isn't just stable, it's expanding. We're in the middle of a massive global electrification push. Governments have committed hundreds of billions toward green energy and decarbonization. Solar deployment is accelerating across the US, Europe, China, India, and beyond. Every new solar installation, every EV on roads, every data center built, that's silver demand that didn't exist 10 years ago. Analyzing silver requires looking beyond the Fed to the real economy. What's actually being built? Is demand growing? And if demand's growing, what's happening with supply? This is where things get truly interesting. Silver supply is strange. Unlike gold, which gets mined primarily as gold, most silver comes as a byproduct from mining other metals: copper, lead, zinc. Silver supply doesn't respond quickly to silver prices. Prices spike? Miners can't just open new silver mines overnight. They need the economics of other metals to justify new projects. This creates supply inelasticity and potential for squeezes. It creates the kindling for explosive moves if demand surges unexpectedly. I'm not claiming a supply squeeze is imminent or selling you hype. I'm explaining why silver's structural picture differs from other assets. It's not just Fed policy or dollar strength. It's physical demand meeting a supply chain that can't flex easily. Let's talk about the gold-silver ratio, because serious precious metals traders watch this religiously. It's simple. Take gold's price, divide by silver's price. The result tells you how many silver ounces by 1 gold ounce. Why does this matter? The ratio moves in cycles. When extremely elevated, gold very expensive relative to silver, it often precedes periods where silver outperforms. Mean reversion kicks in. Traders buy silver, sell gold as a relative value play. When risk appetite returns and the macro environment turns reflationary, silver typically moves harder and faster than gold. Currently, the ratio sits in interesting territory, not at historic extremes, but elevated enough that the relative value crowd is paying attention. If the macro picture shifts, Fed pivots, dollar weakens, risk appetite returns, history suggests silver could start outperforming gold. And when silver outperforms, it doesn't whisper, it screams. Now the dollar, because this trips up many traders. Silver's priced in dollars. Stronger dollar means fewer dollars needed to buy silver. Price drops in dollar terms. Weaker dollar means more dollars needed. Price rises. This isn't just technical, it's about flows. Strong dollar means international buyers pay more in their local currencies, dampening demand. Weak dollar gives international buyers a discount, stimulating demand. With algorithmic strategies trading inverse correlations between the dollar index and commodities, these flows get amplified both directions. Watching silver means watching the dollar, and the dollar's tied to, you guessed it, Fed policy expectations. Everything circles back to this week's data. Hot data likely strengthens the dollar and hits silver. Soft data likely weakens the dollar and lifts silver. It's interconnected. Looking at technicals briefly, I won't give specific price targets because they change too quickly, but I'll discuss structure. The daily chart shows consolidation. Price has been ranging, making lower or roughly equal highs while holding above key support zones. This tells you neither bulls nor bears have control. The market's waiting. Resistance above is where previous rallies stalled. Bulls need to break through there to trigger momentum buying, short covering, and FOMO from sideline traders. Breaking that zone with conviction could mean a move toward new highs. Support below is where previous declines found buyers. Bulls are defending that level. If it breaks, you're looking at deeper correction, potentially shaking out weak hands before recovery. What happens at these levels depends on the catalyst, likely this week's data.
Sentiment around silver right now is tense. Bullish traders are frustrated by the chop. They've been right directionally, but wrong on timing. And timing is everything when you're leveraged or working with limited capital. Bears aren't celebrating either. Silvers refuse to break down despite hawkish pressure. Every dip gets bought, every breakdown attempt reversed. That signals underlying demand, physical demand from stackers, industrial demand from manufacturers, speculative demand from those believing the next big move is up. Then there's the retail stacking community buying physical silver for long-term holds, accumulating on the thesis that fiat currencies are being debased and hard assets preserve value. This group is substantial and vocal. Every price dip looks like opportunity to them, not panic. This creates fascinating dynamics. Short-term traders get chopped up and frustrated, while long-term holders accumulate and wait for the macro turn. Both act rationally for their timeframes, but experience the same price action completely differently. What's the takeaway for you? Depends on who you are and your objectives. Short-term traders face a challenging environment. The range is real, the chop is real, getting stopped out right before a move is real. You need disciplined position sizing, defined risk, and acceptance that you might be early or wrong. Long-term holders or those building positions face different calculations. You're not trying to nail the exact bottom. You're accumulating at reasonable prices before what you believe is a larger move. Volatility becomes opportunity, dips become chances to add. Short-term noise matters less than structural thesis. Let me address a fear I know some carry. What if this is a trap? What if bulls pile in expecting a breakout and hot data crushes silver? Valid concern, and exactly why I emphasize this: don't make decisions based on certainty. Certainty doesn't exist in markets. Make decisions based on probabilities and risk management. Bullish on silver? Fine. Size your position accordingly. Define your risk. Know where you're wrong. Don't bet everything on a single data print. The market exists next week, next month, next year. You don't need heroics. You need survival to catch moves that matter. Bears thinking silver goes lower? Valid thesis. But don't get cocky. Silver has a history of violent upside moves, destroying overstaying shorts. If macro shifts, if the Fed pivots, if the dollar rolls over, being short silver could get excruciatingly painful fast. The smartest approach right now is awareness of both scenarios, letting the market show which is playing out. Watch the data, watch reactions, watch whether price breaks out or down, then act based on what's happening, not what you hope happens. Zooming out to bigger picture context matters because short-term action occurs within larger frameworks. We're living through significant monetary and geopolitical transition. The era of zero rates and unlimited quantitative easing is over, at least for now. Central banks are trying to normalize policy without breaking things. Simultaneously, globalization is being rewired, supply chains reconsidered, countries stockpiling strategic resources, and trust between major powers deteriorating. In this environment, hard assets get attention, not because they're magic or always rise, but because they represent something outside the system. Gold and silver can't be printed, frozen in accounts, or defaulted on. They just exist. In a world where institutional trust is shaky, that quality matters to more people. I'm not saying go all in on metals, that would be irresponsible. But understand why this asset class is getting attention. It's not just internet enthusiasts. Central banks are buying gold at the fastest pace in decades. Countries are building strategic reserves of critical metals. The world is signaling how it sees the future. Silver specifically occupies an interesting position with both monetary appeal and industrial demand. It's simultaneously a bet on fiat currency distrust and on electrification and green energy. Two different narratives pointing the same direction for silver demand. Does this guarantee silver rises? Absolutely not. Nothing's guaranteed. Supply can increase, substitutes can emerge, demand can shift, policy can change.
Those risks are real. But structural tailwinds are also real. When structural tailwinds meet a consolidating market, the eventual move can be significant.
Here are practical thoughts to close.
First, this week's data is important, but not everything. Even if NFP and CPI cause short-term reactions, longer-term trends are driven by the full body of evidence, not single data points. Don't overreact. Don't chase. Let the picture develop. Second, watch the dollar. For a leading indicator of silver's direction, the dollar index is excellent. Dollar weakness is tailwind. Dollar strength is headwind. Third, respect the range until it breaks. Consolidation has defined levels. Until those break decisively, assume the range continues. Expect more chop, more frustration, and position accordingly. Fourth, know your time horizon. Day traders need different strategies than multi-year accumulations. Know which you are. Don't borrow someone else's time frame and wonder why it's failing you. Fifth, manage risk. Silver is volatile. It moves fast and hard. Over-leveraged?
You can be directionally right and still get wrecked because you couldn't survive the drawdown. Position sizing matters. Stops matter. Surviving to trade another day matters. Final thought. Markets will do what they do. Your job isn't perfect prediction. Your job is intelligent positioning for multiple outcomes and adjusting as new information arrives. That's the game. Everything else is ego and entertainment. Now here's what I need from you. If this analysis added real value, hit that subscribe button right now and turn on notifications so you catch every breakdown as markets move. But more importantly, I want to hear from this community. Do you think the worst is over for silver? Or are we setting up for one more leg down before the real move higher? Drop your honest take in the comments below and tell me what you want covered next. I read everything, and your input directly shapes what I focus on. Also, that disclaimer. I'm sharing analysis and educational opinions here to help you think more clearly, not to tell you what to do with your capital. I'm not your financial advisor and don't know your situation. Nothing here is personalized advice. Do your own research, make your own decisions, manage your own risk. Thanks for watching, and I'll see you in the next one.